Today, trillions of dollars move through the stock market, but 400 years ago it didn't even exist. Then one company tried a strange money experiment in 1602, and unknowingly created the global financial system we live in today. Imagine waking up in a world where the stock market never existed. No Wall Street. No trading apps. No investors buying shares of companies. No billion-dollar startups going public. No people checking stock prices on their phones. In that world, companies would struggle to grow. Massive projects like railways, oil empires, technology giants, and global corporations might never exist. But everything we see today, the financial markets, corporate empires, and trillions of dollars flowing through global exchanges, can all be traced back to one unexpected experiment more than 400 years ago. An experiment that began in 1602, when a group of merchants created something the world had never seen before. They didn't realize it at the time, but they were about to invent a system that would transform the global economy forever. This is the story of how one company accidentally invented the modern stock market. To understand how this happened, we need to travel back to a time when the world was very different. In the early 1600s, Europe was obsessed with one thing: spices. Today, spices sit quietly on supermarket shelves. They are cheap and common. But 4 centuries ago, spices were incredibly rare and valuable. Pepper, cinnamon, cloves, and nutmeg were prized luxuries in Europe. They were used to flavor food, preserve meat, and even as medicine. Some spices were so valuable that merchants compared them to precious metals. A sack of nutmeg could sometimes be worth more than its weight in gold. But there was a problem. These spices did not grow in Europe. They came from distant lands thousands of kilometers away, especially from the Spice Islands of Southeast Asia, in areas that are now part of Indonesia. To reach these islands, ships had to sail across dangerous oceans for months or even years. The voyages were extremely risky. Storms could destroy ships. Pirates could attack them. Disease could wipe out entire crews. Sometimes ships simply vanished and were never seen again. For merchants who financed these expeditions, the risks were enormous. Imagine investing your entire fortune into a single ship. If the ship returned successfully, you could become incredibly rich. But if the ship sank or disappeared, everything you owned would be gone. Because of this danger, only the wealthiest merchants could afford to fund these voyages. But even they struggled with the risk. The spice trade was profitable, but it was also unpredictable and dangerous. Then, in the Netherlands, a group of merchants came up with a revolutionary idea. Instead of one merchant paying for an entire expedition, why not divide the cost among many investors? Each investor would contribute money. In return, they would receive a portion of the profits when the ships returned with spices. This simple idea changed everything. In 1602, the Dutch government approved the creation of a powerful trading company called the Dutch East India Company. In Dutch, it was known as the VOC. But what made this company revolutionary was not just its trading power. It was the way it raised money. For the first time in history, a company invited the public to invest in it. Instead of borrowing money or relying on a few wealthy partners, the company sold shares of ownership. Anyone with money could buy a share. By buying a share, investors owned a small piece of the company and would receive a portion of its profits. This was a radical idea. Before this moment, businesses were usually owned by a small group of people. Ownership rarely changed hands. But now, hundreds of investors could own part of a single company. The response was overwhelming. People rushed to invest. Merchants, shopkeepers, wealthy families, and ordinary citizens all wanted a piece of this powerful new company. Within a short time, the Dutch East India Company raised an enormous amount of capital. This money allowed the company to build ships, hire crews, and send large trading fleets across the oceans. For investors, the potential rewards were enormous. If the voyages succeeded, profits could be huge. But something unexpected happened once people owned these shares. Investors realized something important. They didn't have to keep their shares forever. If someone else wanted to buy them, they could sell their shares and take their profits early. Soon investors began meeting in public places in the city of Amsterdam to buy and sell these shares. At first, the trading was informal. People gathered in courtyards, near markets, and in public squares. They negotiated prices. They exchanged ownership documents. But as trading increased, something remarkable happened. A new kind of marketplace was born. This marketplace was not for spices, gold, or physical goods. It was for ownership of companies. This place eventually became known as the Amsterdam Stock Exchange. It was the first official stock exchange in the world. Here, investors could buy and sell shares of the Dutch East India Company. Prices changed depending on supply and demand. If people believed the company would make huge profits, the share price rose. If they feared losses or disasters at sea, the price could fall. For the first time in history, the value of a company could change every day depending on investors' expectations. In other words, the modern concept of the stock market had been born. But the Dutch East India Company was not just a normal business. It quickly became one of the most powerful corporations in history. The Dutch government granted it extraordinary powers. The company could build forts. It could sign treaties. It could establish colonies. It could even wage war. In many ways, the company functioned like a small empire. Its fleets traveled across the Indian Ocean and into Asia. It established trading posts and controlled key spice-producing islands. At its height, the company employed tens of thousands of people. Its ships dominated international trade routes. Historians estimate that the company's total value in today's money could reach trillions of dollars. Some economists even believe it may have been the most valuable company the world has ever seen. But its biggest impact was not the spice trade. It was the financial system it created. The idea of selling shares to investors quickly spread across Europe. Other companies began copying the model. Investors realized they could finance massive projects by selling ownership to the public. This changed the way businesses operated. Instead of relying on a few wealthy individuals, companies could raise enormous amounts of capital from thousands of investors. In England, traders began meeting in coffee houses to buy and sell shares. These gatherings eventually led to the creation of the London Stock Exchange. Across the Atlantic in America, financial markets began forming as well. In 1792, a group of traders signed the famous Buttonwood Agreement under a tree on Wall Street in New York. This agreement laid the foundation for what would eventually become the New York Stock Exchange. Over time, stock markets spread around the world. They financed the construction of railways that connected continents. They helped fund the growth of giant industrial companies. Steel producers, oil companies, and manufacturing empires all used the same basic system invented in 1602. By the late 1800s and early 1900s, stock markets had become the engines of industrial growth. Companies could raise massive amounts of money by selling shares to investors. Investors could share in the profits of successful businesses. But stock markets also had a darker side. Speculation sometimes pushed prices far beyond reality. Investors chased quick profits. Bubbles formed and eventually collapsed. One of the most famous examples occurred in 1929, when the U.S. stock market crashed dramatically. This event triggered the Great Depression, one of the worst economic crises in history. Millions of people lost jobs, savings, and businesses. Governments realized that financial markets needed regulation. New rules were introduced to protect investors and stabilize markets. Despite these challenges, stock markets continued to grow. After World War II, global economies expanded rapidly. New corporations emerged. Technology companies began transforming the world. Stock exchanges became central to modern capitalism. By the late 20th century, financial markets had become global networks. Investors could buy shares in companies located thousands of kilometers away. Computers replaced paper trading. Electronic systems made transactions faster and more efficient. Then came the Internet. Online trading platforms allowed ordinary people to buy stocks from their homes. What once required merchants gathering in Amsterdam could now be done instantly on a computer or smartphone. Today, the global stock market is worth tens of trillions of dollars. Millions of investors participate every day. Pension funds, governments, banks, and individuals all rely on stock markets. Companies raise money to develop new technologies, build infrastructure, and expand their operations. From electric vehicles to artificial intelligence, many of the world's greatest innovations are financed through the stock market. And yet, despite all this complexity and technological advancement, the core idea remains the same as it was in 1602. A company raises money by selling shares. Investors buy those shares and become partial owners. They share both the risks and the rewards. What began as a solution for financing dangerous spice voyages has evolved into the backbone of the modern global economy. 4 centuries ago, Dutch merchants were simply trying to solve a problem. They wanted to reduce risk and fund long-distance trade. They had no idea that their experiment would eventually influence nearly every economy on Earth. But today, the impact of that idea can be seen everywhere. Every stock exchange. Every investment portfolio. Every startup going public. Every financial headline. All of it traces its origins back to a moment in history when one company changed the rules of business forever. The year was 1602. And without realizing it, a group of merchants had just invented the stock market.